Module 3. Types of Investments. Introduction to Module 3. So far, you have learned what a stock is and how the market works. Now it is time to look at your choices. Many beginners think the stock market is only about buying single stocks. That is not true. There are many ways to invest. Each type has its own level of risk. Each has its own style. Let's break them down in simple terms. Lesson 1. Individual stocks. When you buy an individual stock, you buy shares in one company. If that company does well, your stock may rise. If it struggles, your stock may fall. This can bring high rewards. But it can also bring higher risk. For example, companies like Apple Incorporated or Tesla Incorporated have seen strong growth in some years. But even strong companies can have bad periods. When you invest in one company, your money depends on that one business. Lesson 2. Exchange-Traded Funds, ETFs. An ETF is a fund that holds many stocks inside it. Instead of buying one company, you buy a basket of companies. This helps lower risk. If one company falls, others may rise. A popular example is the S&P 500, which tracks 500 large companies. Many ETFs follow this index. ETFs trade like stocks. You can buy and sell them during market hours. For beginners, ETFs are often a simple way to start. Lesson 3. Index Funds. An index fund is similar to an ETF. It also tracks a group of stocks, like the S&P 500. The main difference is how it is bought and sold. Index funds are often bought through fund companies and priced at the end of the trading day. They are simple. They are low cost. They are built for long-term growth. Many long-term investors prefer index funds because they spread risk across many companies. Lesson 4. Bonds. Bonds are different from stocks. When you buy a stock, you own part of a company. When you buy a bond, you lend money to a company or government. In return, they pay you interest. Bonds are usually seen as lower risk than stocks. But they also tend to grow more slowly. Many investors mix stocks and bonds to balance risk. Lesson 5. Dividends. Some companies pay dividends. A dividend is a payment made to shareholders from company profit. Not all companies pay dividends. Some reinvest their money to grow faster. Others share part of their earnings with investors. Dividend investing can create steady income over time. For some people, this is a key goal. Lesson 6. Growth versus value stocks. There are also different styles of stocks. Growth stocks are companies expected to grow fast. They may reinvest profit instead of paying dividends. Prices can rise quickly, but they can also fall fast. Value stocks are companies that may be priced lower than expected. Investors believe they are worth more than the current price. Each style has good and bad periods. Neither is always better. Lesson 7. Blue chip stocks. Blue chip stocks are large well-known companies with a long track record. They are often stable and trusted. They may not grow as fast as smaller firms, but they are seen as safer choices. Many beginners start here because these companies are well known and widely followed. Module 3. Summary. In this module, you learned. Individual stocks give you ownership in one company. ETFs and index funds spread your money across many companies. Bonds are loans that pay interest. Dividends provide income. Growth and value stocks follow different styles. Blue chip stocks are large and stable companies. You now understand that the stock market offers more than one path. In the next module, we will talk about how to prepare before you invest. This includes setting goals, choosing a broker, and knowing your risk level. Smart investing starts with smart setup. Let's keep building.